We're looking at a fundamental analysis arguing Robinhood has officially shed its meme stock skin to become a profitable fintech giant, all based on some massive Q3 2025 numbers.
Let's jump right in.
So the core of this analysis, the thing that gives it its punch, is this idea of a massive shift.
Right, from a story stock to a numbers stock.
Exactly. And using that Q3 data, the $1.27 billion in revenue, that 43% net profit margin, it immediately builds a really strong, bullish case.
The foundation is definitely solid. No one's arguing with those numbers. But while the numbers are great, I'm a little stuck on the tone.
The tone?
Yeah, it's very high energy, very bullish. And while that's engaging, I wonder if it accidentally undermines the whole institutional grade claim the report is trying to make.
That's an interesting point about perception. I can see that. But you have to think about Robinhood's history, right? It was the meme stock. Don't you almost need that aggressive confidence to convince skeptics the old narrative is truly dead?
I get the instinct. I do. You want to overcorrect?
Yeah.
But a fundamental analysis report isn't really supposed to just sell the stock. Its job is rigorous risk assessment. And the way this is structured, it's all about proving the bull case.
So it feels a bit one-sided.
It does. You see these declarative statements, like the volatility we saw today, that's just noise. For a sophisticated reader, that's a red flag. It feels like confirmation bias.
Okay, so that's the real issue. The analysis needs to show it's considered the threats and still finds the company compelling, not that it's just ignoring them.
Exactly, which brings us to our first big point, strengthening analytical credibility by integrating probing counterpoints. You have to show you've priced in the risks.
So the suggestion is to weave in those counterpoints right after the big positive data points.
Precisely. You show the reader you know what they're worried about. So let's take a concrete example. In the financial section, after that amazing 100% year-over-year revenue growth.
And the 43% margin.
Yes. The report mentions the old perception of being a regulatory target, but it just kind of breezes past it.
Right.
Instead, what if there was a dedicated subsection right there, even just a paragraph or two, explicitly discussing the current regulatory landscape?
And in that section, you'd have to actually name the non-zero risks. Maybe delayed international approvals, or the ongoing scrutiny of payment for order flow.
Exactly, and then you use the new Q3 data to show why those risks are mitigated.
You explain why the diversification, the gold memberships, the retirement accounts, that global push, why that actually hedges against future compliance costs.
It's a much more sophisticated argument than just saying regulatory risk is over. You turn a perceived weakness into proof of smart management.
And we should do the same thing with the stock price. The analysis mentions the stock pulled back. What was it, about 25%? From 153 down to 115, even after these great earnings.
And it just dismisses it as froth or noise.
Which, again, undermines that institutional tone.
So instead, the analysis should dig in, identify the specific factors. Was it an institutional rotation? Did a big fund hit a risk limit and have to sell? Was it a technical breakdown?
Analyzing the mechanics of that drop would show the report is robust, that it understands market dynamics beyond just the company's P&L. It proves the analyst isn't just cherry-picking the good news.
Okay, that brings me to the second major area here, the valuation.
The 48x PE ratio.
Exactly. The analysis basically says that multiple is reasonable for a high-growth fintech because of that 100% revenue jump.
Which is a bold claim.
It is, and it needs a lot more support to really stand up to scrutiny.
So the core idea here is deepening the valuation justification. We need to do it through what you might call a quality of growth segmentation.
Perfect phrasing. We need to dissect that 100% growth number.
Show that it's sustainable.
Right, because the weakness is that it leans entirely on that one big number. But the report itself notes that the crypto supercycle boosted crypto revenue by 300%.
A huge, huge part of the growth.
And that's a highly cyclical, completely unpredictable element. If crypto cools off, that whole 100% growth narrative just crumbles, and suddenly 48 times earnings looks
extremely aggressive, not reasonable.
So the suggestion is to disaggregate that growth. You have to separate it into its core parts.
You're talking about stable, recurring revenue like the gold membership fees versus the high volatility stuff like the crypto transaction fees.
You have to. Segmenting it like that provides much stronger evidence to support the high multiple. It gives the reader confidence in the core business, independent of whatever the market is doing.
So a concrete example would be to run a scenario analysis right after presenting that $1.27 billion revenue figure.
Yes. Project what the sustainable growth rate would look like if the crypto market just normalized.
What if that 300% crypto jump came back down to earth, say a more conservative 50% year over year? what does the business look like then?
That exercise is so crucial. It isolates the durability of the core business: subscriptions, equity trading, interest income. And suddenly the justification for that 48x PE isn't just a risky bet on a hot market.
It becomes a calculated assumption based on demonstrable operational resilience.
And to build on that, the analysis mentions those analyst price targets, 171 and 180. To really back those up, you need comparative context.
Right. It's not enough to just say the multiple is reasonable.
No, you need a brief comparative analysis. Find a few other high-growth fintech peers, even if they're not perfect comps, that are also growing revenue by 100%. What kind of multiples do they trade at?
That grounds the whole valuation in reality. It shifts the argument from, trust us, this company is special, to,
This company's performance is in line with, or even better than, its peers. And therefore, this multiple is statistically justified. It's just a different level of rigor.
okay, let's move to our third and final opportunity, which is really about verifying those Q3 numbers. The analysis makes a really compelling case for this cash machine thesis.
It does. The numbers are fantastic. $556 million in net income, that 43% margin.
A 61-cent EPS, it's all great. But for a fundamental analysis, especially of a turnaround, you can't just stop at accounting profit.
That's such a critical point. To make that cash flow positive, margin expanding fintech giant claim stick, you have to go beyond GAAP net income. You need to integrate the balance sheet and cash flow statements.
Yeah, completeness is the issue here. The weakness is that the deep dive is almost entirely focused on the income statement. For a true turnaround story, especially one with an aggressive global expansion like the Indonesia push,
You have to verify the quality of those earnings and the liquidity. Those things are just absent right now.
so the suggestion is pretty straightforward. Bolster the core financial section. We need to add in key measures of solvency, liquidity, actual cash generation.
This is where we see if the cash machine narrative is real or just, an accounting story.
For a concrete example, the analysis has to use free cash flow, FCF.
Absolutely.
Relying on the $556 million in GAAP net income only tells you part of it. Net income can be influenced by all sorts of non-cash charges.
Depreciation, amortization.
Right. But free cash flow tells you how much actual cash the company is printing from its operations.
And that FCF figure, if it's strong, confirms exactly how much real liquidity is available for those big strategic moves. You mentioned the Indonesia expansion. That takes real cash.
FCF validates that. It validates the ability to do buybacks, pay dividends. It shows that the $556 million in profit is actually backed by cash.
And because this is such a high-growth story, liquidity is everything. The analysis has to include some assessment of the company's current liquidity.
What's the current ratio? How much cash do they have on hand versus their debt?
Quantifying that resilience adds so much weight to the financial powerhouse narrative. Any serious investor is going to immediately ask about the balance sheet stability.
So you have to answer that question before they even ask it.
You do. Providing those metrics, especially with aggressive growth, turns a potential question mark into a definitive exclamation point. It's the difference between saying they made a profit and saying
They generated a mountain of flexible, deployable cash. This has been a really productive critique. The underlying thesis in this analysis of Robinhood's transition is incredibly strong. The data's there.
it really is. Our focus today was just on elevating that powerful thesis into a truly undeniable institutional report by focusing on 3 pillars. First, integrating risk and counterarguments to boost credibility. That means really analyzing the regulatory environment and the recent stock dip, not just dismissing them. Second, strengthening that valuation. You have to differentiate between the stable growth and the cyclical, crypto-driven growth to truly justify that 48x PE multiple.
And finally, bringing in the balance sheet and cash flow metrics, specifically free cash flow and the current ratio, to get a complete picture that actually verifies the cash machine thesis.
You have a fantastic story here, backed by powerful data that shows Robinhood really isn't a meme stock anymore.